Welcome back. Investors appear to be upbeat after Canada announced it is rescinding the digital services tax targeting big tech companies. And Prime Minister Mark Carney and U.S. President Donald Trump have announced they will resume trade negotiations aimed at reaching a deal by July the 21st. Let's get some perspective on market reaction from Brianne Gardner, Senior Wealth Manager of Velocity Investment Partners at Raymond James. Brianne, thanks a lot for joining us. Is this news germane to the markets? Is this news on the digital services tax and the resumption of trade talks between the two countries market relevant?
I mean, I think we've seen such a strong run up, obviously, since the sell-off that we experienced in April. I mean, even the S&P 500 rose 3.4% this past week to new highs. I think everyone was watching it closely. I mean, especially over the weekend of, now trade talks are almost becoming back in focus. A lot of it was, kind of pushed onto the back burner, delayed. But now trade and tariffs have been kind of dominated the theme a little bit more, picking up again. So for us, I mean, it's something that we're watching. I think the markets are still not reacting, too poorly, as you can see across the board, pretty positive. But I think that, Trump and Carney, they said over the weekend, they're very complex negotiations and they're going to continue to put, each country's best interest first. So we will watch and see how that unfolds. I think you always see, a little aggression from what that looks like out of the start, and then the negotiation starts at the table. So for us, it's a little bit of a wait and see from that perspective.
Meanwhile, the S&P TSX Composite Index is up about 8% so far this year, outpacing U.S. markets, even though those U.S. markets are now materially above break even for 2025. What is your view, Brianne, of Canadian stocks after they have posted a pretty good 6 months, and I guess more to the point, a pretty good past 3 months? We're looking now at that explosive rally that we've seen since the early portion of April. What's your view of Canadian stocks?
Yeah, I would say we remain still a little bit cautiously optimistic, especially with rate cuts and potential rate cuts. Again, I think Canada has done a great job, at cutting at least a little earlier than the Fed. And I think that has helped avoid, a major recession for Canada, whether that's just delayed our recession and we will see, 2 negative quarters the next quarters. It's a little bit of a wait and see. Right now, Bank of Canada has about a 37% chance that they are going to be doing a rate cut in July, so likely not. But I do think that stocks have really comfortably, as you mentioned, outpaced the U.S. markets this year, and the TSX. I mean, early strength really came from energy and gold, those two sectors, right? But the momentum is, I think, now starting to show some cracks or fade a little bit. We are seeing a little bit of uncertainty that is mounting up. So I think you're seeing softer economic data, a little bit of some of these breakdowns in trade talks. That has added pressure. And again, wait and see from these Bank of Canada of how many more cuts that we are going to see. So I do think the U.S. has a little bit more leverage from that perspective, which we could see, the second half of the year, the U.S. start to outperform Canada. And I do think there has been a little concentration in the TSX too, obviously with the materials sector and energy that have made up, 30% plus of the returns. But I think still focusing on high quality names with resilient fundamentals will continue to be the play for investors.
And how, briefly, how would you define a high quality name with resilient fundamentals?
Yeah, I mean, we have a pretty strict rules-based investing philosophy on how we qualify a stock. It has to rank a minimum 7 out of 10 for us. Fundamentally and technically, we use fundamental for qualifying. So there's about 12 different sectors that we have to, or credentials we have to go through, and then technical from an entry point. So again, I think it's just looking at, cash flow, balance sheet, upside potential of that stock. How the stock has done, is it fit below or above its 50-day moving average, looking at, dividend yield, P ratio, et cetera. And then I think, big picture, where are things going? I mean, July, we've seen since kind of 1928, the S&P 500 has seen an average monthly return of 1.7%. And since 2015, the S&P has been positive 80% of the time. So for us, a lot of people have that sell in May and go away, but we have just come off the back of a pretty strong June and now heading into, a month that does tend to be strong, July, before we head into a little bit more of seasonal weakness. We are a little bit positive for the markets heading into this month.
It won't be long before we are back into earnings season in the United States. After an uncertain first quarter, earnings growth was robust. Guidance was very uncertain, if it existed at all. What's your expectation for the next set of U.S. corporate earnings?
Yeah, I think everyone and economists and analysts across the board were pretty bullish coming into July and the beginning of 2025, right? I think we have seen corporate earnings starting the year strong, largely really due to better margins over top line growth. However, we do anticipate a slowdown a little bit as tariffs do impact and filter through the economy and filter through businesses. So to us, I am seeing a little bit of early signs of pressures that are emerging. I think consumer spending, especially posting its first decline of the year, and core PCE rising more than expected. So for us, again, we are a little cautiously optimistic and watching all of the data as it is coming out in close detail. So the consumer's still out there, consumer's still spending, but we are starting to see cracks in the economy, and the consumer makes up 70% of GDP growth. So if we start seeing slowdown of the consumer, we will start to see slowdown of growth in the economy.